All right, strap in, everyone, because we're diving headfirst into the U.S. economy today.
Yep.
And let me tell you, things are getting interesting.
Interesting might be an understatement.
Okay, fair enough. Interesting and a little wild, maybe. We're talking inflation, of course. Always inflation.
Can't seem to shake it.
Nope, not yet. And then there's the Fed trying to figure out what to do about it with all those tricky decisions. And then looming in the background, we've got this possibility of, what do the economists call it?
Stagflation.
Stagflation, right? That delightful mix of high inflation and no economic growth.
Ouch.
Yeah, ouch is right. Like, the economy's stuck in traffic.
Price is going up, but we're not actually getting anywhere.
Perfect analogy. I like that.
And to really get into the weeds on all of this, we've got this fascinating analysis piece by, get this, Mimiz James.
Mimiz James. Okay, that's a name.
Definitely unique, right? But their analysis is spot on, especially considering Trump's, surprise win.
Yeah, no one saw that coming, especially not the pollsters. Okay, so Mimiz James, what's their big takeaway here?
Well, they start off by highlighting this weird situation with inflation, right? It's going down, which is good.
Good news, finally.
Right. But it's not dropping as fast as, well, anyone expected.
He's being stubborn.
It's like, have you ever tried to get ketchup out of a glass bottle? You get those first few drops, and then...
And then nothing, just stuck.
Exactly. And that's what economists are calling sticky inflation.
Sticky inflation, I love that term.
Right, so descriptive.
It is. Okay, so sticky inflation, got it. What else is Mimiz James worried about? What else is making them nervous?
So they dig into this concept called structural inflation, and basically it means that there are these underlying factors in the economy that are just keeping prices high.
Even when demand goes down.
Exactly. Even when people aren't, clamoring to buy more stuff, the prices just stay high.
Because the cost of actually making and doing things is still high?
You got it. Think of it like going to the grocery store, right? Fewer people are buying milk, but the price doesn't drop.
Because, what, the cows still gotta eat?
Haha, exactly. The cows still gotta eat, the milk still needs to be transported, all those costs haven't gone down, so the price of milk stays up.
Fascinating. So it's not just about how much people want to buy something, it's also about how much it costs to make and sell it.
Exactly. And some of the big culprits right now are tight labor markets, so basically not enough workers to go around, and then also, the ever-increasing cost of housing.
Those are definitely big issues, and that leads us to, I think, this concept called cost-push inflation, right?
Right.
Mimiz James mentioned that.
They did. They think it's a key factor right now. And it makes sense when you think about it. Like, imagine you're a business owner.
Okay, I'm a business owner. I'm in.
Suddenly, all your costs go up, everything, wages, materials, energy, you name it.
And I want to stay in business, so.
You got to raise your prices.
Right, makes sense. Pass those costs along to the customer.
Exactly. And that's cost-push inflation in a nutshell. Businesses are being forced to raise prices because their costs are going up.
So even if the Fed tries to do its thing, raise interest rates to cool down demand, it might not be enough to actually bring inflation down if these structural cost push factors are still in play.
It's like trying to put out a fire with, I don't know, a squirt gun.
You need the big guns.
You need the fire hose, for sure.
And that brings us to this whole stagflation thing, this threat that's looming over everything. Can you remind me what exactly stagflation is? And why is Mimiz James sounding the alarm about it? What makes him so worried?
Okay, so stagflation, it's basically the worst of all worlds, right? High inflation, slow economic growth, and high unemployment.
Like a triple whammy of bad economic news.
It's like getting hit by a bus, and then the bus reverses and hits you again.
And then drives over you again for good measure.
Exactly. And Mimiz James, they're drawing this parallel to the 1970s when the U.S. went through this really painful period of stagflation.
Oh, not the 70s. Anything but the 70s. Bell bottoms and stagflation, no thank you.
Yeah. Definitely not a decade we want to repeat. And what's interesting is that Mimiz James is pointing to this thing they call the oil tax effect from back then.
Oil tax effect. Okay, I'm intrigued. Tell me more.
So back in the 70s, you had this skyrocketing oil prices, right? And those price increases, they acted like this hidden tax on consumers.
A hidden tax. Interesting. So everything just got more expensive.
Everything got more expensive. It drove up costs for everyone, businesses, consumers, and ultimately it just ended up hurting economic growth.
So are they saying we're headed for another oil crisis? Like, is that the big warning here?
And exactly, I mean, we're not facing an oil crisis like we did in the 70s, but Mimi's James argues that the tariffs on imported goods, the ones from Trump's first term,
Right. Those tariffs, they caused a lot of controversy.
they did. And Mimi's James thinks those tariffs could end up having a similar effect to those oil price shocks from the 70s.
So tariffs are like a hidden tax, too.
In a way, yeah, because when you put tariffs on imported goods, those goods become more expensive for everyone.
Businesses, consumers, everyone down the line.
Exactly. And that, according to Ms. James, could lead to, you guessed it, stagflation.
History repeating itself, different circumstances, but same outcome.
Potentially. Yeah, it's like different players, same game, different field, same rules.
And the Fed is caught right in the middle of all of this.
They are, and they're in a tough spot trying to control inflation and maximize employment at the same time.
But with stagflation looming, it's like they're damned if they do and damned if they don't.
Exactly. And to illustrate this dilemma, Ms. James brings up this fascinating concept called the prisoner's dilemma.
Ooh, game theory. Now we're talking. I love a good game theory analogy, but maybe we should explain it for our listeners who haven't brushed up on their game theory lately. What is the prisoner's dilemma, and what does it have to do with the Fed?
Okay, so imagine the Fed has these two prisoners, right? Two goals they're trying to achieve: controlling inflation and boosting employment.
Dual mandate, right?
Exactly. But the problem is they're in this situation where they can't fully achieve both goals at the same time.
So it's a trade-off. You help one prisoner, you hurt the other.
It's like a seesaw. If you push down on one side, the other side goes up. If they raise interest rates aggressively to fight inflation, they risk triggering a recession and hurting employment.
But if they keep rates low to support jobs and growth, they could make inflation even worse.
So they're stuck between a rock and a hard place. Classic no-win scenario, at least in the short term.
And then you add another layer of complexity on top of all of that. With Trump back in the White House, his policies could have a huge impact, right?
Oh, absolutely. What Trump does or doesn't do will definitely have ripple effects throughout the economy. So what's Ms. James's take on this? What do they think Trump's going to do? Well, based on his first term and the current economic landscape, they're predicting that Trump is going to prioritize growth over fighting inflation.
Makes sense. He's always been about growth, the art of the deal, building things up.
Exactly. So they think he might be willing to, tolerate slightly higher inflation, maybe around 3 to 3.5%, to hit those growth targets.
It's a gamble, right? Hoping for short-term gains, but risking more inflation down the line.
It is a gamble, for sure. High-stakes poker with the economy.
So we've got sticky inflation, the threat of stagflation, the Fed's caught in this prisoner's dilemma, and Trump's rolling the dice on a risky growth strategy.
It's a lot.
It's a lot. Where do we go from here? What's the next chapter in this economic thriller?
Well, that's what we'll unpack next. We'll dive into what the experts are saying about the Fed's next move, how the markets are reacting, and what it all means for all of us trying to make sense of this crazy economic puzzle.
I'm on the edge of my seat already. Let's do it.
Yeah.
So we left off with the Fed stuck in this prisoner's dilemma, right? Trying to decide whether to fight inflation or support jobs and growth.
Yeah. It's a tough call. No easy answers.
Nope. And everyone's got an opinion on what they should do. Beavis James mentioned some forecasts, right?
Mm-hmm.
From different analysts and institutions.
They did, and there's a lot of disagreement, as you might expect.
Makes sense, given all the uncertainty.
Right. But even without a crystal ball, it's helpful to see what these different groups are predicting just to get a sense of the range of possibilities.
So who's saying what? Give us the rundown.
Okay, so Nomura Securities, they're a big global financial services group. They're predicting that the Fed will only cut rates once in 2025 and then another cut in mid-2026.
So not very aggressive.
Nope, pretty cautious. And one reason they're hesitant about big rate cuts is that they've actually raised their implied neutral rate to 3.625%.
Hold on. Implied neutral rate, remind me what that is again?
It's basically the interest rate that neither stimulates nor restricts economic growth.
The Goldilocks rate, not too hot, not too cold.
Exactly. And Nomura raising their implied neutral rate means they think the Fed might need to keep rates higher for longer than we previously thought.
Because of those tariffs we were talking about earlier.
Could be, yeah. Remember, Ms. James thinks those tariffs could keep inflation stickier for longer?
Right, okay, so Nomura is on team caution. What about other forecasts? Any that are more optimistic about rate cuts?
Oh, yeah. JP Morgan, for example, they're predicting that the Fed will be a bit more aggressive with those cuts. They're forecasting 4 rate cuts throughout 2025, starting as early as March.
Wow, that's a lot faster than Nomura.
It is, and their implied neutral rate is lower too, sitting at 3.5%. So they seem to think the Fed has a bit more wiggle room.
Okay, so we've got cautious Nomura, more dovish JP Morgan. Any other perspectives out there?
DBS Bank, they think the Fed might cut rates even more aggressively than JP Morgan, somewhere between 100 and 150 basis points by the end of Trump's term.
Whoa, that's a lot of cuts.
Yeah, that could be 4 to 6 quarter point cuts.
They're really going for it.
They are, and they see the terminal rate, the rate where the Fed finally stops cutting, landing somewhere between 3.5 and 4%.
Okay, so we've got a real spectrum of opinions here,
Mm.
from 1 cut to 6 cuts. Cautious to aggressive.
It really highlights the uncertainty, doesn't it? No one knows for sure what's going to happen.
But speaking of differing opinions, we can't forget about Jamie Dimon, the CEO of JP Morgan. He's out there predicting rates could go as high as 7 or 8%. That seems crazy compared to all these predictions of rate cuts.
He's definitely a contrarian voice in this whole debate. He's been warning about inflation for a while now, and he thinks the Fed might have to, slam on the brakes to get it under control.
So he's saying, forget about rate cuts, we might need to raise rates even higher.
Basically, yeah, he's more worried about the long-term damage of high inflation than he is about the short-term pain of a recession.
It's like he's playing a different game than everyone else.
It really is, and it just goes to show that there's no one-size-fits-all answer here. The Fed has to weigh the risks and benefits of each option, and whatever they decide, it's going to have ripple effects throughout the economy.
Okay, so all this talk about forecasts and predictions, it's making my head spin a bit. What does it all mean for the average person? How can we use this information to, make smart decisions about our own finances?
That's the million-dollar question, right? And I think the key takeaway is to be aware of these different perspectives and understand the potential risks and opportunities each scenario presents. Don't put all your eggs in one basket.
So diversify, right. Classic advice, but it applies here.
Absolutely. Diversification is key, both in terms of your investments and your overall financial planning.
Don't assume anyone has all the answers.
Nope. And be prepared for different economic scenarios. Things could go in a lot of different directions.
Makes sense. What else should we keep in mind?
Well, focus on what you can control. You can't control the Fed or the markets, but you can control your spending, your saving, your investment strategy.
So build a solid financial foundation no matter what happens.
Exactly. And finally, stay informed, keep learning, the economy's constantly changing, and staying up to date on the latest trends can help you make better decisions.
All right, so stay informed, diversify, and focus on what you can control. Solid advice. But we're not done with this deep dive just yet, are we? Mrs. James's analysis is actually focused on a specific Fed meeting, right?
You're right. This whole analysis is building up to this crucial meeting where the Fed will make its next big decision on interest rates.
Okay, so before we get to that meeting, there's one more thing I'm curious about. We talked a lot about the Fed's dual mandate, controlling inflation and maximizing employment. But remember earlier when we were talking about inflation, you mentioned that the Fed seems to be shifting its focus away from solely battling inflation, putting more weight on employment stability now.
Yeah, that's right. It seems like they're increasingly concerned about the potential for a recession and the impact that would have on jobs.
So how does this shift in focus play into this upcoming Fed meeting? What should we be listening for from Chair Powell when he speaks?
I think there are a few key things to watch for. First, what are the Fed's projections for inflation under Trump? Are they buying into this Trumpflation narrative, the idea that his policies could lead to higher inflation?
Right, because if they are worried about Trumpflation, they might be less inclined to cut rates.
Exactly. Second, listen for any hints about the October non-farm payroll data. This data tells us about the health of the job market. Is the economy slowing down? Are we seeing signs of a potential recession?
Because if the job market is weakening, the Fed might feel more pressure to cut rates to try and boost the economy.
Right. And finally, keep an ear out for any comments about the neutral rate, that theoretical rate we were talking about earlier. Remember how Nomura raised their implied neutral rate? Well, it'll be interesting to see if Powell gives any indication of whether the Fed is thinking along the same lines.
So if Powell hints that the Fed is also raising its view of the neutral rate, that could signal they're leaning towards keeping rates higher for longer.
Exactly. Basically, pay attention to how Powell addresses these three key issues: Trumpflation, the job market, and the neutral rate. Any shifts in their thinking on these could signal a change in their overall approach.
It sounds like there's a lot riding on this meeting in Powell's comments.
Oh, absolutely. The Fed is in a tricky spot, and the market is going to be hanging on their every word.
It's like we're watching this economic thriller unfold in real time, you know?
Oh,
So much uncertainty, so many potential plot twists.
it's a real nail biter, that's for sure. But at least thanks to Mimi's James, we have a better idea of, what to look out for.
Right, like they've given us this roadmap for navigating this crazy economic landscape.
Exactly, a framework for understanding all the moving parts.
Okay, so let's pretend we're the Fed for a minute. We're facing this prisoner's dilemma. Everyone's got an opinion. The markets are going wild. What do we do? What's our best move?
Ooh, that's a tough one. If I had to put on my Fed chair hat for a minute, I'd say their best bet is probably to proceed with caution.
Not rock the boat too much.
Exactly, maybe a small rate cut, just to signal that they're paying attention to the economic headwinds, but they shouldn't get too aggressive.
So kind of a middle ground approach, not too hawkish, not too dovish.
Yeah, find that sweet spot. Acknowledge the risks to growth, but also make it clear that they're not going to let inflation spiral out of control.
It's a balancing act, for sure, a tightrope walk.
It is. And of course, they have to keep an eye on what Trump does, how his policies play out and adjust their strategy accordingly.
Right, because he's a bit of a wild card in all of this.
He is. Definitely adds another layer of complexity.
Okay, so as we wrap up this deep dive, what are the key takeaways our listeners should remember? What are the big lessons here?
Well, first and foremost, I think it's crucial to understand that we're in uncharted territory here. There's so much uncertainty, so many conflicting forces. No one really knows what the Fed will do or what the future holds.
Buckle up, basically.
Yeah, buckle up because it could be a bumpy ride. And second, even though the Fed has a huge impact on the economy, you as an individual, you have a lot of control over your own financial well-being. You can make smart choices with your money no matter what the Fed does.
Focus on what you can control, right? We've heard that before, but it's so important.
It is. And finally, I think this deep dive has really highlighted the importance of staying informed, being a critical thinker. Don't just blindly follow the headlines or take anyone's word for it. Do your own research, consider different perspectives, and make decisions that are right for you.
Love that. Couldn't agree more. Well, I think that's a great place to end it. We've covered a lot of ground today. Sticky inflation, prisoner's dilemma, the Fed's big meeting. It's been a wild ride through the world of economics.
It has definitely a lot to digest.
But hopefully our listeners feel a little more equipped to understand what's happening and why it matters.
That's the goal, to empower people with knowledge and information.
Exactly. And if you want to dive even deeper into the analysis we discussed today, be sure to check out Mimi's James's Substack. They've got some really insightful stuff over there.
Definitely worth a read.
All right, that's a wrap for our deep dive into the U.S. economy. Thanks for joining us, and we'll see you next time for another fascinating exploration of, well, whatever's got us curious,